Hi guys, so welcome to this particular video. This video is going to be brief, and this video will be revealing one of my deepest weapons when it comes to the financial markets. And it's one of my deepest secrets when it comes to trading in the markets on the intraday perspective, right? So understanding this would help you to day trade and to swing trade, right? And what are we talking about? We are talking about the ICT power of trade. This is one thing that I use most times when I'm day trading. If you are on my public community, you hear me saying things like buying below the daily open, selling above the daily open, right? So I want you guys to understand this concept in this short video, right? So now, the power of three is a concept I learned from the inner circle trader, which tries to explain how the market candles operate, right? So we're trying to look at how the candles operate, how they usually look, right? So now this is a typical example of a candle. Forget this line in between. Just this is what a candle looks like, right? This is how a candle looks, a trading candle, right? Now we have the upper wick here. We have the this as well. This is a you just put some labelings here, right? So you just mark certain points, you just put some lines at certain point, right? You know that I don't want to start putting too much label, right? You already know what all these things are, right? You already know what these stuffs are, right? I just quickly put them in so you can understand. So you know that already that this is this as well. This put something here that this is a bullish candle, right? So let us say this is a bullish candle. And let's say this is bullish, right? If this is a bullish candle, what does this mean? This means that this point is where the open of the candle, right? So I have the open here. I have the open. I want you guys to get this gist. I want to label so you guys can see. So this is the open of the candle, right? So if the candle opens there, what should that be? What would this be? The low, right? So this becomes the low of the candle, right? So this becomes the low of the candle, right? Right. I want you guys to get this gist as I'm typing it in, so you guys can get it. So this is the low of the candle. What is this point? This is the low right here. What is this? The close, right? So we simply put in there. This is the close of the candle. I want you guys to get this gist. Just follow me, please. Just follow me. It's a very powerful concept. If you can understand this concept, then you're on your way to consistent profitability when it comes to the financial market, right? Is the close, and then what is this? The high. So this is your high of the candle. So this is your high. Right? This I'm just labeling it so you know what the daily candle looks like. So this is your high, right? This is the high of the candle. But this for a bullish. For a bearish is the reverse. And for a bearish candle, open goes up and close comes down, right? It's just the reverse for a bearish. Now, what is this a bullish candle? This is what the bullish candle looks like. Now, the ICT power of three is suggesting that when the market is bullish, the candle opens and runs below before going higher. That is the whole explanation of the power of three. That the bullish candle first opens and rallies below before running higher. So this is what a bullish candle looks like. I will tell you guys what this information simply means on what it indicates. So if you are bullish on the market on an intraday perspective, it simply means that if you're bullish, you want to be buying when when price has gone below the open price, or when it is done making the rally down. So this whole move from this open to the down is what we call manipulation, right? So the rally is called manipulation, right? It's what we call a manipulation, because the market intends to go higher, but first of all, it's going lower. So that's rally down is what we refer to as what manipulation, right? So the rally down from this open down to this low is what we call manipulation, right? Why the what sells price below, right? When the market opens, it accumulates short orders and then goes down first. And then when it has finished manipulating, then it distributes to the upside. So the movement from this open up to this high is also called distribution, right? So this is the market opens, accumulates short orders, runs below, giving us the manipulation. So this is the manipulation, right? This move down is also called the manipulation, right? Then we now have what we call the distribution. The distribution is when the market moves in the original intended direction, right? So this is what we call distribution I want you guys to get this thing. If you get it, you're made, right? So you now have what's called distribution. When the market does what? When the market is done manipulating, then this whole move from back to the high is also called distribution. So for a bearish example, it's just the reverse. Market to open, run above, manipulate, and then distribute to the downside. So distribution is both for long and for short. It does not matter what side of the market you're trading, right? Just understand that when the market is bullish, it first of all goes the opposite direction. Called that move is called a manipulation, and before it goes what the original direction, which is called what the distribution. So if you're bullish now, you wait for price to go below. Note, you are not trying to catch the low or to catch this very low. No. You wait for price to go below. Once it goes below the open price, you now look for what? Confirmations to go as long. So if you see a confirmation, maybe a lower time frame confirmation to go long, then you cannot buy and maybe buy until the market makes its what high and then start to retrace. So you can close or maybe you hold to the next day, right? So that is how a candle books. So your goal as a trader in an intraday perspective is to buy below open or at the open. You can even buy around there. Just know that just see that the market has gone below and try to buy as much as possible very close to the open. Try to buy as much as possible to this open because this open acts as a kind of support, right? So you want to buy either below, around the open, or a little bit above it. So just make sure that price has done what? Done this manipulation, and you want to be catching what? This big candle to the upside when you're bullish. Why if you're bearish is the reverse, you understand? So let me just quickly do that. Sorry, trying to do something. Okay. All right. Now for a bearish example, the same thing applies. You have your yeah, same thing for a bearish example. This for a bearish example now. So this for a bearish, right? So this for a bearish example. I have to take it as so you guys can understand what I'm talking about. So it's just the reverse for a bearish example. Very easy. So for a bearish example, you have this very easy, right? So bearish market opens. This one becomes a high, this is the reverse, and this becomes a low, right? So market opens, rallies above, that was called a manipulation, and then it rallies below. So if you're selling, you want to be selling when the market has made this rally higher, and then you look for a confirmation to do what to go short. It's just the reverse of the case, right? Now, I want you guys to know something. Now, when we are using the open, what time do we use as the open of the day? What is the time we use for open? Note, the time we use is the New York time or EST, Eastern time, right? So we're using what? New York time, right? We're not using the broker time. We have to use the time for New York to decide what's the open. So the open at what New York time. That's what we're using for our open, not your broker time. So you simply come to this UTC here, click on time zones, then you click on what's New York. You see a lot of them here. You put it as New York, so it can be set to New York. So click on New York so that it will be set as New York. So you can easily see where they open, right? If you're in Nigeria, the current New York time for midnight is 5 a.m. So you look for 5 a.m. because New York is 5 hours behind us. So that 12 a.m. is our 5 a.m. So you use the 5 a.m. time to identify the midnight open time. Well, the midnight open, you can call it the daily open or the midnight open, whatever you feel to call it, right? So that you use the New York time for your decision, right? Now, let me notice. Now, for swing trades, you use the weekly candle. So if you're a swing trade, you use the weekly for this. So you use the weekly candle. So you open the weekly candle and wait for price to go below. And possibly, you usually see market do that between Monday and Tuesday. Therefore, Wednesday, price will begin to do what? Begin to get distributed. That means if this is a weekly chart now, if the market wants to be bullish, on Monday, you will typically see markets go down first, maybe Monday and the middle of Tuesday. Then maybe from the ending of Tuesday to Wednesday, market will do what? It's now reverse and start doing what's going the intended direction. That's why on Wednesday, we usually have a very smooth trading day on Wednesday because by Wednesday, the market must have been done with what is manipulative leg, right? You now need to see Wednesday doesn't go in the original direction, right? So let's go to reach out to illustrate what I'm talking about, right? Now let's simply look at the weekly charts. Let's have the weekly perspective before we go to the daily, right? So for swing trades, let's take a look. Have you noticed that? Let's look at this point. Look at it. When the market wanted to be bullish, notice that each bullish candle did what? It first of all opened and ran below before they was going higher. Did it? You can see open, run below, go higher, right? If this one open, this one they don't really go lower somewhere because there was a gap here. There was a kind of gap. I don't know. Okay, that was a kind of weekend gap or something. Look at this as well. You can see that this was the only one. You know that this is not 100% accurate. It's not 100%. There are times in which it does not happen. But if you're bullish, if there are 10 candles, you should see at least 7 print this bullish pattern. So you can see that this was bullish, and almost all the candles did the same thing. Open, you see how it ran below, taking as previous weekly low, and then rally higher. The same thing here, open, went below, rally higher, open. So this is how the candle books. So you can now look at the chart from the lower time frame perspective to see if the market is ready to do what it wants to do. So let us quickly look at the days. Let's look at just last week. Let's look at last week. All right. So the market wanted to sell. So market has, since the market took out this liquidity here, market has been bearish, right? So let's look at just last week. Let us see which day the market reversed and started selling, right? So this was, let's just mark that high. Look at last week candle, not this week. Look at the week of the candle of last week. So this is last week candle. So look at this. This is the one who just mark this area, and then we go to the daily time frame to see it. So we go to the daily now. So this was this is Wednesday, right? So this Wednesday. So let me also quickly take my replay to here. Let me cut off this. All right. So this is last week. So last week began on Monday, right? So this is Monday. So let's just mark. Oh yeah, this Sunday. Okay. So you can see that what happened. The market did what? It's open there. So this was our weekly open, right? This was our weekly open. Can you see how the market opened on Monday? Is run above first. Can you see the manipulative leg? And when it did this, why did it sell off? It came to do what? To hit the low of this other block. So markets rally to hit the low of this other block here. This is another block because after this kind of you can see this big down candle after it. So market rally came to hit this other block before doing what? Before going short. All right. So that is how it works. So you can see how the market finished manipulating. It now sold on Tuesday, Wednesday, and then Thursday sold as well. Then that's why the reversal of Friday. All right, that is how this thing books. All right, now let's go to the daily chart. Now let's go to the daily. They're done with the weekly now. So if you're swinging trades, look for the market to do its high before they what going lower. All right, that's how to do it. Now for the daily, you can see the market was bullish. Look at all these bullish move. Can you see the market was open, run below, high, open, run below, high, open, run below, high. So you can see that the candles that went opposite were very few compared to where the market is. So you have to identify when the market is ready to move. Maybe you see a lower time frame break of structure, and then you see open, run below, high, open, run below, high, open, run below, high. If this was to open, you can see how this thing looks. So whenever you have a bias on the day, always wait for the market to do what? To run above or run below and give you what? Your intended move. All right? That's how the market books. All right. So now let us talk about this for a bit. So now, when you open your daily chart, you remember that you're using what the New York Times to look for what daily open. So you simply do what you open your 15-minute charts, right? This is for a daily chart now. You open your 15-minute chart and then you expand it. So you simply come. Let's look at yesterday, right? Let's look at yesterday. Market was kind of bearish yesterday. So let's look at yesterday, right? Yesterday was Tuesday. Now this Tuesday, right? This was Tuesday, yesterday. Look at it. So this is my daily chart. Now remember that we're using was New York time. My times already set at New York. So I'll simply bring us a vertical line and look for midnight. So where's midnight here? This is a midnight here, right? This is a midnight time. So this is a midnight open. What happened? Market opened because we are bearish. And I sold you yesterday. What happened? I said market rallied higher. What did he do? He took out this liquidity here. So if I put in my Asian range, you can see that the market took out the Asian high. So this indicator is called Q zones. So you can actually put it in. So I can show you an Asian range, right? Asian range is between this time period, right? So it's between 7 to 12 New York time. So let us delete it here. This is not correct. Let me just put it here. This 7 o'clock. This 7. So what is it? So that's how I look at Asian range between this period. All right, so let's take this off. So you can see the market did what? Is well below Asian high. This was Asian high. Asian high is simply what the highest high at this point, and then this is the lowest point. So you can see markets went look at this is daily open, right? Daily open, markets rallied above and then do what? Down below. So if you are selling, as the market took out this high here, you're looking for what's maybe a lower time frame confirmation inside there to do what? To go short, right? That is how this market books. It books this way every single day. So I want you guys to do me a favor, open your 15 minutes chart on each individual day. It's when if the market is clearly bullish or bearish. I'm not talking about the ranges. If the market is clearly bullish or bearish, usually see the market do this. The market will open. If it's bearish, run above and then what? Dump. If the market is bullish, it opens, go below before what? Before buying. Right? You can see how this day happened. Look at another day. This market wanted to buy. Look at this. There was a kind of bullish move here. So where's our midnight open here? Yeah. What happened? The market did what? It ran below first before they was buying. It ran below, right? Took out this old low and then it was bought to take out this Asian. So this is also our Asian range. We take from 7 to 9. So the market, first of all, it ran below Asian low, it ran below, gave us a short, a long opportunity. Then it bought, it took out this low and then it bought. So the market is bullish. First of all, it goes down first. And then, so if you're bearish, first of all, wait for the market to want to go below if you want to buy it, and then wait for the market to go above. So when the market goes below, you look for what? A lower time frame confirmation. So this is not a video about lower time frame confirmation, right? Just to show you guys how the market books, right? Just look at it from this perspective. So for a daily chart, you use the New York time and look for midnight. Wait for the market to run below and then look for buys. If it's bearish, able to run above before look for what sells, right? I hope this video was insightful. We have more of this with lower time frame confirmations. I taught my paid students how to look for lower time frame confirmations, all of those fun stuff in the paid mentorship, right? So if you want to have access to all that information, how to enter with this, I didn't share entries here. So you want to know how to enter, when to enter, the exact time period to look for entries. I share that in the paid mentorship group, right? And it's very, very affordable. A yearly subscription of what? 45,000, which is about $58 right now. So if you want to get that, also want to send me a DM or use the seller link in the description to join us immediately, right? So see you guys in class. I hope it was insightful. I wish you guys the best and do the best with this information.